Thank you so much for inviting me here today. It's a pleasure to be here. My name is Allison Clark, and I'm the Associate Director of Impact Investments at the MacArthur Foundation. We are a Chicago-based foundation with over 30 years of impact investing experience. We've invested about $500 million to date across a number of sectors, including education, affordable housing, economic development. We've also invested heavily in our hometown of Chicago. First, for some context, MacArthur is roughly the 13th largest private foundation in the United States. We have about $6 billion in our endowment. Of that, about $500 million has been allocated to do impact investing. And our grant making each year is about $250 million across a number of national and international initiatives. Our goal with our impacting capital in particular is designed to help make the global impact investment marketplace more inclusive, more efficient, and effective. Today I want to share a few of the lessons that we've learned over the past 30 years and to give you a sense of where MacArthur is headed as we try to play a catalytic role in the development of the impact marketplace. Historically, our primary tool for making impact investments has been PRIs, or program-related investments. And for those of you who are not familiar, PRIs is a tool that philanthropies in the United States can use to further our charitable mission. We can make investments so long as they're made on terms that no profit-seeking individual or institution would make them. So in the case of our work, we typically are making 10-year loans to nonprofit organizations on an unsecured basis at a fixed interest rate of 1 or 2%. So in terms of the spectrum of investments we were talking about this morning, we are definitely on the philanthropic concessionary end. And we really see our goal as trying to make direct investments and also find ways to bring other investors into this marketplace. When we first started making impact investments 30 years ago, we were highly opportunistic in the way that we approached the work that we were doing. Basically, if something came to us and it seemed like a good idea, we experimented and tried to make those investments. And we did a lot of things, and we made a lot of investments, but honestly, we didn't necessarily have the impact, as we were just talking about before. How do you measure impact and make sure that you're doing something not just good, but that has a meaningful impact for the organizations that receive the capital and for the issues at hand? And so one of the things that we stopped after about 10 years of this and did an analysis of the work we had done and realized that while we were doing a lot of good stuff, we weren't necessarily changing the issues or the trajectory for the field itself. So after 10 years of investing in a variety of deals and areas, we took stock of what we had done and decided to change course. We made a conscious decision to link the deployment of our impact capital to areas where we had specific grant-making strategies and where we could use that capital to substantially advance our charitable work. It was no longer enough to do deals that were good. Instead, they had to meet a different threshold. If we don't do this, if we don't inject our capital into key actors or to key segments within the marketplace, are we hurting our ability to actually achieve our grant-making goals? Impact capital, in other words, couldn't be an add-on to our work, but it had to be an essential thing that was baked into the theory of change at the outset. So this change represented the beginning of what we consider to be sort of our second phase or second era of impact investing work, the conscious alignment of our capital with grant-driven strategies. So the biggest example of this alignment is one of the initiatives that we are most well known for, and that is our longstanding engagement with affordable rental housing. In 2001, the foundation launched a program to support the preservation of existing rental housing. This is multifamily housing with or without government direct support that is in many circumstances at risk for falling out of the affordable housing stock, either through functional obsolescence because owners can't invest in the properties to maintain them as a quality rental housing asset, or because of changing dynamics in the neighborhood where a neighborhood may be gentrifying and a property owner may be inclined to sell to a market rate owner. We did some preliminary research as we approached entering this field and learned that for every 1 unit of new production, 2 units were falling out of the affordable marketplace because of the 2 factors that I mentioned. And we were driven to try to reverse this course because we felt that this represented not only a loss in public investment in terms of support that had already been given to these projects, but it also was representing a loss of what we considered to be a really critical infrastructure of housing in the United States that was supporting working families and individuals. So this initiative, which we called the Window of Opportunity, included grant support for advocacy and research, and for the first time, the conscious inclusion of impact capital into the grant-making strategy. Loans were made to approximately 25 regional nonprofit housing organizations and financial intermediaries to directly support the acquisition, rehabilitation, and preservation of this rental housing. We also sought to change how the housing industry, government, financial markets value and support the preservation of this rental housing. We wanted to try to rebalance the housing conversation in the United States away from new production and home ownership to also focus on preserving the existing assets that we already had. We also hoped to encourage policymakers to make it easier for these types of transactions to be done by reducing the friction between the way public subsidy and private markets approach the preservation transactions. We believed such a major shift would benefit low-income individuals and communities, and also would help allocate resources more effectively so that properties could be preserved that were close to job centers rather than encouraging development to occur farther and farther outside of communities, farther from jobs, and also from key institutions like hospitals, schools, and grocery stores. Over the 16 years that we've been involved in this initiative, we have invested approximately $187 million in grants, loans, and other financial vehicles in support of this effort. The loans that we made to nonprofit organizations was essentially equity-like capital that let these organizations hire staff, invest in new technologies, and create pools of working capital internally that they could use to bridge public resources, grants from philanthropic investors in these projects, and also allow them to smooth out timing differences between subsidy programs that might be coming in from government agencies and the construction loans that were often financing these projects. Collectively, the organizations we've invested in so far have preserved over 150,000 units of housing. Now that's not nearly enough, but that's an enormous start. And we're hoping that by the time that these investments mature in 2020, that these organizations will have increased that to be able to have said that they've preserved 300,000 units. And these have been done in urban areas, suburban areas, and in rural areas all throughout the United States, which is incredibly exciting. But more importantly for us, these organizations have been strengthened by this borrowing, both because they've been able to have the capital they needed, which vastly reduced the time for them to acquire these assets, but also because now they have the ability to demonstrate to traditional lenders that they can borrow money at an entity level, so not the project level, but the entity level, that they can manage that debt and that they can repay it. And that's an enormous change from where this field was. And I know it's a little different here in the UK, but in the United States, where these nonprofit owners have to own properties with tremendous financial restrictions with what they can do with them, they can't re-lever them the same way that the organizations here in the UK can. This is really critical for these organizations to be able to demonstrate that they can borrow money and repay it based on the strength of their own operations. So we're very proud of this work that we've done in affordable housing, and we could have easily stayed in this field for a very long time. That would have made me very happy. However, as an institution, we really feel that the use of our capital should be used for what we would consider R&D for the fields. We want to try to find areas of the marketplace that are broken and then try to improve or fix them so that other capital can come in. Because as I like to say, we're a $6 billion foundation, which feels like a lot of money, but in terms of what we actually do with our impact investing with $500 million, that's still a very small lever to move some very big rocks. So, faced with the question of do more or do it differently, we chose the latter path. We took what we'd learned over these first two eras and decided that we wanted to try to innovate with some new financial structures and products to try to bring more impact investment capital into this marketplace, and specifically to try to identify what barriers were keeping other key institutions from coming into these types of deals. And this really is, for us, the third era of our impact investing work, that we just started with some innovative projects that I'm going to talk a little bit about, and then I'll give a sense of where we think we're going forward. So first, we recently invested in what we call a liquidity facility. And this is a $15 million facility that we created to help a nonprofit-sponsored REIT, or real estate investment trust, in the United States to help raise $50 million in capital. So let me back up and give a little context. And real estate investment trusts in the United States are typically owned by for-profit individuals and institutions. And in this case, 12 nonprofit housing owners, most of whom were preservation-minded owners that we had supported in the past, identified that there were market rate affordable properties, so properties that did not have government restrictions. They wanted to be able to acquire these properties and hold them. And these are going to be predominantly for low-income workforce housing that are in high-cost urban areas in the United States. So when they first came up with this idea about 5 or 6 years ago, they asked us for support. And because it fit with the preservation strategy that I had mentioned before, we invested $10 million of equity into this REIT. And that was at the time the single largest equity investment that we've made outside of our traditional investments portfolio, but in terms of impact investing, that's a big investment for us. And at that time, we were joined by Prudential Social Investment and Ford Foundation, who also provided capital. And we launched this initiative, and it was incredibly successful. And in 18 months, they had used all of that capital, acquiring 1,000 units in properties in 6 different states. And they needed more capital. Ultimately, the goal of this REIT is to become a publicly traded entity, but they can't get there yet. They needed that interim capital that one of the speakers was talking about earlier to get them to the next level. Well, we are probably the foundation in the United States that has the greatest support for rental housing, so we would be the logical partner to come to. But we already had $10 million of capital invested in this project. We couldn't put in more capital on top of that. So what we decided to do was to try to look for ways to help leverage other investors who might want to come into this transaction. So we found there were 3 partners that were interested in investing additional equity into this investment. But the pushback they were getting from their investment committees was, there's no liquidity, there's no exit for us. And even though these are banks that all are subject to something in the United States called the Community Reinvestment Act, which mandates that banks invest in the communities from which they take deposits, and they would get benefit for this, this was still too big of an ask for them to make of their investment committee. So what we created was a $15 million liquidity facility, which essentially is like a put. So these 3 investors, Morgan Stanley, Citibank, and Schwab, invested $50 million, and they have the ability to sell $15 million of those shares back to us over a period of time, which gives them the ability not to fully liquidate their position, but to reduce their exposure to the REIT over some period of time. And this worked, and we were able to help these 3 organizations close on $50 million of really critical capital for this REIT to be able to continue and grow. And their hope is that with this, they're able to continue to build out their pipeline, and the goal is for them to ultimately have $250 million of equity and own between 10 and 15,000 units of rental housing over the next 10 years. So that was a big deal, and that was one that we worked incredibly hard to get done. It's not one that I think that we would have been able to do, even though this was, we came at this with the idea of trying to bring in people from the marketplace that hadn't been in it before. It certainly helped that we were coming from the position of knowing the space of rental housing really well. I don't think our own investment committee would have expected us to do a $10 million equity investment or a $15 million transaction like this in a field that we didn't have deep knowledge of. So the second transaction that I want to talk about is one that's closer to home, and this is something that we launched last year called Benefit Chicago. And this is a $100 million fund that we have launched with 2 partners in Chicago, with the Chicago Community Trust, who is our local community foundation, and with Calvert Foundation that was referenced before. So this is a $100 million fund, and it's designed to mobilize capital that can be invested in nonprofit, for-profit, and social ventures in Chicago. This is a little bit different for us. We have a long history of investing in Chicago, but that's mostly been through the vehicles of investing in affordable housing and in community development finance. This $100 million fund is going to be a mission-agnostic fund, so essentially we won't be constrained by any particular programmatic strategies, but it all does have to benefit the Chicago area. We spent some time trying to size what we thought the need was in the marketplace, and we found that we thought that there was between $100 and $400 million worth of need within nonprofit organizations, specialized funds, for-profit social ventures, et cetera, for this type of flexible capital that isn't currently available in the marketplace. So we decided we would start at the low end. We would raise $100 million and hope that we were proved that A, we could raise that capital, and B, that we could invest it, and that we could go back to the marketplace and say we need more. So what we've done is we've created a fund It's $50 million of MacArthur money. It's $15 million from the Chicago Community Trust, and the remaining $35 million we're raising from individuals and institutions through the sale of a note that the Calvert Foundation has created called a Community Impact Note. And these are notes that can be bought in tenures of 1 to 10 years. They carry an interest rate of 1 to 4%. We're blending those together. They can be bought for as little as $20, and the largest investor who's making an investment in the fund right now is $10 million. We pool all this capital together into a $100 million fund that can then be invested in these projects throughout Chicago. We, MacArthur, are supporting this by doing the underwriting, the marketing, the asset management for these loans. And I'm happy to say that after we will have reached our 1-year launch date for receiving applications in July, but already we have $200 million worth of applications that have come to the foundation that are in the process of being underwritten. Not all of them will work. But there's some really exciting opportunities, and for a foundation that has spent most of their time focused on community development and affordable housing, it's really exciting to see the types of social ventures that are coming forward across a whole variety of sectors, everything from one company who's experimenting with providing tablets to increase training opportunities for people who are currently incarcerated in the Chicago area, to people who are looking at green technologies, looking at biodigesters. I'm still learning all of this myself. It's really exciting to see the level of innovation that's happening in Chicago. So that for us was a really key strategy to try to figure out, can we not only figure out a way to provide a vehicle for people to come forward at the individual level, again, dollar amounts as small as $20, and blend that with people who have significant financial commitments to Chicago through their contributions to the Chicago Community Trust, blend that together in a sort of democratization of this type of effort so that we can all invest in the city that we love. So the last deal that I'll talk about is one that's actually happening just now, and is one I'm incredibly excited about, because I think that this will be the first time that there's ever been a syndicated PRI transaction in the United States. So one of the challenges that there's lots of triple bottom line funds out there, and I know we've heard about some of them this morning, but one of the barriers that we've seen in the United States has been that the level of investment required is often too high for smaller foundations, community foundations, and some key institutions to be able to invest. It's also a high bar for organizations that have never done impact investing before, where to get your trustees to invest money, if it's more than $1 million, that feels like a lot. So we were presented with the opportunity. There's a real estate development fund that's being launched in the southern United States. Now, southern United States is not a target area of MacArthur, and this is a multi-investor or multi-asset type of fund, so it'll be focusing on medical facilities, industrial facilities, commercial, retail corridors, et cetera. This is not something we've ever done before, so that was not the hook that brought us into this transaction. But what did make us excited was that we had heard from the fund manager that one of the challenges they were having, where there were smaller investors, minimum investment size in this fund is $3 million. Smaller investors couldn't come in because there wasn't a way for them to be able to get into this transaction. And they couldn't go more than $1 million because their trustees weren't excited about this opportunity of doing it first. So we had been looking for an opportunity to try to syndicate a transaction, and we thought this was a good one. So earlier this week, our board just approved us to make a $10 million investment into this fund, which our hope will be that we will be able to then sell participations in that fund to smaller foundations. People are looking at investing anywhere between $350,000 and $1 million, and there's several that have lined up already that are interested for two reasons. A, because this lets them come in because it's less than the $3 million, but also because they get to come in with an experienced partner with MacArthur Foundation, and we're not providing any credit enhancement, so any losses they incur are their own. We're not doing any underwriting. Everyone has to underwrite this different, on their own using different methods. But what it's doing is it's allowing for an aggregation of capital to come into an area that doesn't have a lot of resources like some of the bigger marketplaces. This is a fund that's not going to be focusing on Atlanta and Houston, but it's going to be focusing on Tuscaloosa, El Paso, Birmingham. These aren't necessarily markets that spring to your mind because they're small. These are secondary and tertiary markets. So for us, this is an incredibly exciting thing. And what's different about this is the fact that we're taking the upfront risk of $10 million. We have to commit that. But the hope is then we'll be able to bring in some smaller players. And these are small numbers relative to some of the things we've been talking about with enormous global goals. But if this model works, we think that then this can be something that can be used in other sectors. So I guess the thing I want to leave you with is this. So while these deals all feel very small and bespoke within their own marketplaces, what we're really trying to do here with this is to try to think about ways to experiment with bringing different types of products to bear so that we can become more of a market maker. Because the ability for us to use our capital to be able to change trajectories in any one sector is big, but it's not nearly enough. We don't have nearly enough capital to try to change the trajectory for a lot of these issues that we're talking about. So we need more market makers. We need more people to experiment with products and to try to invest in platforms that can try to let us move and bring more capital into these sectors and into these spaces. So we're looking to try to partner with other institutions, both nationally and internationally, to try to focus on this market-making effort. And I think it's very exciting, and our board is very excited about it, because impact investing needs more market makers. We think there's tremendous power in this type of market making, and are excited to see it grow and expand. For us, it means getting beyond the day-to-day work that we've been involved in with investing on a deal-by-deal basis, because ultimately, while we believe that the deal-by-deal transactions are good and do create impact, it's not going to change the world. But we do think that building a more inclusive and effective marketplace that allows for investors from the small individual to the larger institutions to be able to come in and play in this space potentially can. Thank you.